Another business day is upon us. Good morning, everyone. Welcome to 55 minutes of current and relevant business conversations. That's what we do on Business Morning. And I'm Ini John Mekwan. We start, as we would normally do, from the global space, seeing what's happening with global oil prices. We see that prices fell today after the U.S. and Iran agreed to hold talks in Oman tomorrow, Friday, easing concerns of a potential military conflict between them that could disrupt supply from the key Middle East producing region. So we see for this morning, looking at the prices, a red color is what we see for Brent. It's more than 1% down, 1.4% at $68.47 a barrel. WTI is also down 1.4% at $64.23 a barrel. Oil prices surged about 3% yesterday after a media report suggested that planned talks between the United States and Iran on Friday could collapse. However, later in the day, officials from both sides said that talks would go ahead tomorrow, though the topics up for discussions have not been settled yet. And Iran says that they are open to discussing their nuclear program, including uranium enrichment with Western countries, while the U.S. also wants to include Iran's ballistic missiles and its support for armed proxy groups around the Middle East and its treatment of its own people. To other stories now, value-added tax, that's VAT, allocations to the federal government, the state and local government areas rose sharply last year, 2025, and combined it hit 7.7 trillion naira for the whole year. This is according to data from the Federation Accounts Allocation Committee, that's FAAC. The figure represents one of the highest annual VAT disbursements on record, reflecting stronger consumption levels, improved tax administration, and broader coverage of VAT collection across the economy. VAT receipts are shared monthly among the three tiers of government, providing a key source of non-oil revenue. Under the existing revenue sharing formula, the federal government received 15% of that total amount. States shared 50%, while local government areas had 35%. The increased inflows boosted fiscal capacity at the subnational level, helping states and councils fund recurrent spending and capital projects amid ongoing revenue pressures. And yes, PMI is out from the CBN. We saw earlier this week from Stanbic and NESG. Well, now we have Nigeria's business activity from the Central Bank of Nigeria, and they say that it expanded further in January 2026. That's according to the Purchasing Managers Index of the CBN. It went up to 55.7%, and it signals a 14th consecutive month of expansion. PMI reading above 50, we know the threshold that indicates growth in private sector activity, suggesting sustained improvement in economic conditions at the start of the year. The January figure reflects continued resilience across key sectors, supported by stronger output levels, improved demand, and relative stability in supply chains. According to the CBN data, firms reported increases in new orders and production, while employment levels improved, also showed modest improvement as businesses adjusted capacity to meet rising demand. Input cost pressures, though still present, eased slightly compared with previous months, and that has helped to support business confidence. We see the markets now and see how it closed yesterday. It was a very positive close at the end of trading in Nigeria yesterday. Look at the numbers, and we see all share was up 1.28% at 168,030.18. Equity cap, that's the money, 107.861 trillion naira. There, of course, we see an improvement there. It was about 3 trillion naira that was added. I mean, 1.33 trillion naira that was added at the close of trade. Activity chart, however, was all red. From volume to value and deals, they were all in the red, 694.79, value 20.57 billion, and deals 42,095. Top gainers, Dark Communication, Berger, and that's Julius Berger and FTG Insurance. Top losers were Red Starex, Deep Cap, and Numerate. Top trades, Charms, Universal Insurance, and First Whole Co. First Whole Co recovered and then saw a little bit of more profit taking, and then yesterday we saw it in the top trades. Well, following that, we've been seeing a lot of results coming in from the NGX, of course, from the corporate, and we'll be having that conversation with Mr. Odemezwe right here in the studio. But first, let's see the latest, and the latest is from Aradel. Aradel's results was released yesterday, and you can get it, of course, from the NGX website. So we see revenue for Aradex. We saw revenue up there, 20% change in the green. That's when you look at it from year to year. This is for December ended 31st, 2025. So we see from December 2025, we're 697.3, 20% higher than what you had in 2024. However, gross profit was in the red, EBITDA in the red, profit before tax in the red, and profit after tax, however, improved. There's a story right there. I hope Mr. Odemezwe will be able to explain that to us. When we see profit before tax in the red, however, profit after tax in the green. Volumes lifted, increased, and we know a lot of production. We had a lot of new rigs happened in Nigeria last year. The federal government has been very proud of that, and they've not kept quiet about it. Volumes lifted, we see, was 26% higher. Volume of refined products sold also went up 62%. However, average realized oil in the red, average realized gas price in the red. And also from this sector, the oil and gas sector, we saw O&O. O&O also, they have also released, we talked about that earlier, but I mean, just talk about the oil and gas sector. We saw, obviously, to follow the trend of what happened in Aradel, yeah? So we see profit after tax was up for, just like Aradel, O&O. Revenue also up, crude oil trading volumes changed, and we saw expanded expenditure increased. When the government say that we have more rigs, it's the private sector that's running it, right? So contract optimization initiatives are approximately 17.7 million across. And I know on the global scene, Ladi will give you more of the results later on during global news segment. But now let's bring in Mr. Odemezwe, Chief Consultant for Flaming Consultant. Thank you so much.
Academy and Consulting Limited.
Thank you so much.
Training company in Africa.
The foremost indeed. You'll pay for that advert.
Forgive me.
Okay, so I mean, it was a very active year for the oil and gas sector last year. And do we see that captured in the results? Let's see the Aradel, and then we'll see the, so we have it, revenue was up, and then gross profit was, however, in the red. This for Aradel.
Okay.
But
there are two figures for December here.
Yeah.
December 2024 and December 2024, so that it's a bit confusing. Which one do we take here? You know, we're comparing 2024 and 2025.
Yes.
So let's take it that this is the real figure. You know, right? So you'll see that, like here, the red is a bit confusing.
Yeah.
This is the revenue. There's a
so the revenue,
here.
so it's 581, 581.
The price of oil in 2025.
Yes.
It was neither here nor there. You know, going up and down because of the events around the world, geopolitical risks and all of that. So, but you find most companies, depending on their productive capacity, you know, able to have increase in revenue. But the pricing wasn't quite exciting for most of them. And that's why you see, you know, maybe that increase in revenue, but the changes, negative changes, you know, in some of the lines, are not as impressive as should be in terms of growth in profitability. Okay,
let's see O1. Okay.
All right. You know, if you look at this, profit before tax, you know, it's lower here than it was here. Apparently, even if revenue grew, the pricing wasn't fantastic for most of this.
Okay, that's what this tells us.
For Aradel,
yes. Let's see O&O and compare that. So O&O, we see there's profit after tax.
Okay, now, caution here.
Okay.
You know, O&O is a different story altogether.
Oh, from Aradel.
2025, is their very first year of running effectively as a big boy production and exploration company, following the acquisition of the NAOC, Nigerian Agri-Oil Company assets in 2024. So for them, 2025 was the first year. They had to roll up their sleeves and get to work from acquisition activities or post-acquisition activities. And for the first time had to go into full activity, the usage of their assets. So moving from post-acquisition to asset delivery or asset usage or utilization to begin to produce. When they moved in from acquisition, they have to begin to unbundle these assets, maintain them, put them up, change a few of the assets.
And I guess that's why we see that capital expenditure
fantastic,
increase.
And of course, even if you go to expenses, so they also spend a little more because they have to get new people, new ideas, and all of that. So that's a year for sowing for them. Reaping will still come for the investors. Here, what they did was to make sure that these assets begin to work. Even some new well development program. Out of 36 wells, for example, they were able to start one, last year. You can imagine when there are 35 also coming. So what you see in Oando, based on their previous structure, focusing a lot more on trading, everything has just changed. So you see their revenue dropping. Why? Because they had to reclassify, they had to rebalance their balance sheet, moving away from the narrow margin trading activity. Of course, you know that we have a player now who owns that sector. That's the PMS trading and so on. We have a refinery in Nigeria now that tries to provide almost the whole requirement of gasoline and PMS in Nigeria. So Oando is just trying to now strategically move away from that area where the margins are now turning out, and a player now has a bigger advantage than others in that market. So they are now moving their balance sheet more into the new acquired, activity in oil and gas.
Yeah, because we see that the report is that major indigenous players saw substantial gains because obviously the government cleared 28 new oil field development plans worth 18.2 billion, and for Aradel and O&O, profits grew by about 10% to 241 and all of that. So
okay, so that's the point I was making, that for O&O you will see heavy drop in their revenue because they stop focusing on oil trading and then ramp up their production. If you look at their production, total production capacity increased by 2%. They produce much more oil, about 32,000. That's net to them. It's a joint venture, a barrel of oil equivalent per day. That's a massive growth. And then even gas production also grew by about 24%. And then the natural gas liquids, was almost insignificant, but now it's grown by almost 700%. So now you can see that the shift is from oil trading, that's downstream activity, to upstream.
So we can expect more of that.
Now, as their balance sheet now consolidates in this, upstream activity, you will begin to see real, value creation in their assets. And the revenue will now reflect a company that's now divested, or moved or rebalanced from trading to upstream activity. And of course, the margins there, we hope, are going to get better, depending on what oil price, even though the company has taken a position to, do what we call hedging prices at $59 per barrel. So that no matter how low oil price goes, they are sure of having deals above $59 per barrel. So at the end of the day, depending on how the oil price goes, O&O has now kept, put all the assets ready for activity, in 2026 going forward. So you will see all of that in the way they have restructured their balance sheet, spent so much money to put things in order, and then now we're waiting for action to start. So 2025 was a cleanup year, and even the drop in the revenue is not out of distress. It's a strategic decision by management.
Reinvestment.
Yes.
So what can investors actually expect from this sector this year? We know, I mean, even before you came on, we talked about the global oil, what's happening, the meeting between the U.S. and Iran, and how that's moving. Exactly.
Shooting down the drone and all of that.
Exactly.
I think the U.S. president has tried very carefully to avoid any escalation with Iran again. So it won't be like too much trouble to one nation, in almost less than a year. So he has tried to avoid, he had promised to shoot, as they were shooting the protesters, that he was going to be shooting them too, but we saw that die down. And the protest is also somehow abated.
It's not in the front of a lot of news anymore.
Yes, it's going down a bit, and that's also all these diplomatic discussions to see how killings will stop. You don't go and take people who are protesting and kill them, hang them. that they're committing felony or whatever. So, but then as they are doing the diplomatic discussions, you also saw U.S. Massive army military assets moving close to to Iran. They are positioning all the U.S. positions around the Arabian nations. So, but with that, Iran also started flaring up. We don't like, even though you've said we are going to discuss, but we don't like the way you're positioning your assets around us. We are scared about it, and then they took action.
And all of this bring uncertainty.
Yeah, and the market does not like uncertainty.
Obviously.
So you will see that would have made the oil price start going up, which could be to the advantage of Nigerian oil and gas companies. Usually, whenever global oil price, inches up, Nigerian companies gain a lot, and particularly the indigenous company like O&O and Aradel and the rest of them is good news for them, even though it has other impacts to all of us, in the way we buy, pump price of petroleum. So, but we are watching what's going to happen in a few days. Remember that Venezuela is also on the board. Russia oil is still not flowing, even though there's also a discussion going on now between Russia and U.S. and Ukraine. If that happens too, it has a downward pressure on oil price because Russia will begin to flow out. All the sanctions will be lifted. So there are mixed feelings. Right from last year till this year, there are varied feelings around production quantity, around and demand for oil, around
so what
prices.
does this do to an indigenous company like,
for an indigenous
especially
company
when you say they have placed,
Yeah, they have positioned themselves for better production, so they will have to wait and see how prices will affect while they produce enough, which is good, and Nigeria is also not doing badly with OPEC quota that we have. So we have
even though we have not hit it.
We haven't hit it, but we're saying that production is not suffering in Nigeria. We have the capacity to produce. The likes of O&O are producing more, rather than the rest of them. So the point is that productivity is not a problem now. The assets are now efficiently utilized, like O&O and other players. Now, the only concern is, will prices be stable for them to be able to plan their expenses and all of that and end up with positive figures at the end of the year. So nobody can predict that.
So we had a good record when it comes to oil thefts and vandalism last year.
It's been dealt with, mostly.
To a large extent.
Even though if you look at the expenses, you find that they have spent so much now in securing. They had one or two incidences last year, which were immediately arrested. Being a homeboy, being a home company, they know where these things happen. And they were able to quickly resolve that issue. That was around October or so. They were able to deal with that, and they started production immediately. So we don't expect that theft will be much of a problem for our oil explorers in Nigeria, particularly the home people. O&O is the leading indigenous integrated oil and gas company. And with the advantage they have, we don't see theft being a concern. It's being dealt with, but it's still a factor.
Yeah.
All right?
So what can investors expect this year? Now, they've released their results. It's not looking as good as would have wanted it because of the divestment.
Oil and gas has remained a mainstay of our economy. All right, so investors will not always have much to fear in investing in that sector, particularly when there is operational efficiency, when companies are investing properly in human capital and engineering equipment. So it will always be a place to invest in, and a profitable business, by the way. The only major risk, I must emphasize again, is global oil price games going on. So can we estimate, for example, that Russia and Ukraine will be resolved this year? If we do, it's not such a very wonderful news for our producers. Can we also estimate that the Iran-US tension will also, abate? It's also not a fantastic news. However, there are other factors that affect oil prices, global demand and all of that, and even the U.S. position, whether U.S. is going to end up this year also a net exporter or net importer. These factors are all very important. And of course, other decisions, central bank decisions, Bank of England is going to do interest rate announcement this afternoon. U.S. Federal Reserve is also trying to, even though inflation is now largely reined in around the world, but those concerns still exist. And as productivity begins to climb up, even with Ukraine, Russia being resolved, we may see bigger level of demand at the same time. So this may balance, and we'll see prices still hovering around $60 to $70 per barrel, which, if it happens, I expect the Nigerian producers will record a very good year in 2026.
What about the Nigerian government when we put it against the benchmark?
Yeah, it means that our budget we should be able to roll something close to our budget. You know, we always, like last year, I think we budgeted about 75.
Yeah.
And you see where it's trading right now. So it's not such a very wonderful news. And that made our currency not perform so wonderful. But now it is strengthening based on the happenings in the global oil market right now.
So, but why does it seem like the government intentionally overprices our benchmark? Is it a deliberate economic?
It's being optimistic. You know, Nigeria has
overly optimistic.
We are trying to avoid a very large deficit in our budget. We always want to pray, you know, that miracle will happen and oil price stays very high. But I think it's a major risk to our balance sheet as a country. It's a major risk to our budget, annual budget estimations. So, but we have to, you know, come back to the table and think of how do we diversify Nigeria's economy from dependence on oil? How do we ramp up non-oil production so that whatever the oil price is, we won't lose headache over it? We always budget that, that the price will be 75 or so. They're hanging on to it because if you don't do that, our revenue will be so abysmally poor compared to our global budget. I mean, total spend, capital and the recurrent expenditure. So you just hope. You know, budget is hope. Sometimes it's hope against hope.
Hopeful expenses. All right, thank you so much, Mr. Demetrius, for your time and helping us to understand in between the numbers.
All right, thank you for inviting me.
All right, we're still discussing oil and gas, and we're now being joined by Mr. Bismarck Ruwani, who's joining us virtually. And Mr. Ruwani, good morning and welcome to the program.
Good morning, and nice to be here.
So let's look at it from the Dangote perspective. Well, we are so looking forward to Dangote listing this year because then we'll also be discussing Dangote the way we have just discussed Owendu and Aradel. You are close to sources, Mr. Ruwani. When can we expect this listing? Because a lot of people are asking, they want to be a part of this very juicy refinery.
I have 4 words for you. 4 words to answer your question. Keep your fingers crossed.
It will start paining me after a bit, Mr. Ruwani. So I wish we would know.
Keep your fingers crossed, Kenny. Don't be too much in a hurry.
Okay, all right.
Every good thing comes slowly. Okay. So.
Okay, so we also hear that Dangote refinery.
It's going to be a winning investment. Make no mistake about that. 1, invest in naira, get your dividend in dollars. That's the first thing that you have to note. Okay.
I hope the ordinary people will be allowed to invest.
No, everybody. It's a democratization of the economic process, you know, so everybody will get a bite, right? But now that you talk about, let me go back to the oil price and the refining process in Nigeria and the effects of the Dangote refinery. 1, the oil price at $67 a barrel is based on the fact that we think that the US and Iran are going to be talking about how to have a nuclear deal, which the world had before, and it was cancelled. Now we're going to go back to that. Not so much about killing protesters, or because Iran is a very hot spot, so you don't want anything to spill over. So right now, we have to be very clear as to what we think. But one thing you have to note, and I listened to your previous speaker, there's a difference between prediction and projection. Predictions are made like clairvoyant soothsayers who say that it's going to, this is going to happen, that man is going to die, or this, you know, specific outcomes. Projections are what we do, telling you the conditions, under these conditions and under this scenario, this will be the likely outcome. So you are not a prediction person, you are not a soothsayer, but you believe in projections. Having said that, there are 3 things that you have to clear your mind about the Dangote refinery. The Dangote refinery is what we call a merchant. They have a merchant model rather than a pipeline model. In other words, they import crude or different crudes and blend from different parts of the world and blend it together and process. So what you find at the end of the day is that it's more like the Rotterdam, the Singapore model, where you import, refine, and then sell out, as against Oman, Saudi Arabia, where the pipeline goes straight to the refinery and you produce from there. 2 is that there's the production, pricing, and distribution model. Production is optimized, because you're even taking crude from Nigeria, taking some crude, imported crude, and putting it there, and producing naphtha, producing PMS, producing diesel, and producing dual-purpose kerosene. So the production is optimized, and they're testing for a full. In February, the Dangote refinery is going to be testing for optimal and maximum utilization in February. Therefore, using a single train model, they'll be able to maximize output. Two is pricing. The pricing issues between the independent marketers and importers, other refineries, and Dangote refinery has pretty much settled. We now know who the price leaders are, and we now know who the price followers. But there's something in it. There's a win-win situation. Winning for the man who has invested, or the company that has invested over $25 to $30 billion in the Nigerian refining space, and those who have also invested in tank farms and are importing some products and also buying from the Dangote refinery. Dangote refinery has 4,000 trucks, CNG-powered trucks, to deliver across the country, almost at uniform pricing. They also have a marine evacuation by boat, but outside of Lagos, that works. That is, they deliver with their barges all the way to Warri, Port Harcourt, Calabar, and other areas. But for Lagos, there are two options: one by boat, which is more expensive, or by truck. So we have that. We have the distribution model, which is efficient. We have the pricing, which has been optimized in terms of comparing the Nigerian price. You can now see that there's almost an equivalent price, both by NNPC stations and the Dangote, the MRS refinery. So everything seems to be working. But what we must not forget is that before now, and I've said it many times, last year and the year before and previous years, we had clearly queues, we had distortions, and we had instability in production. Now, those are things of the past. All that we know is that we can produce all that we need, export some as well, and that there's last Christmas, no queues, last New Year, no queues, Salah is coming up next month, no queues, Easter. So the days of queues are past. The days of multiple pricing is almost over. And also the days of poor quality imports, which damage people's cars, is also over. I think that we have to bear that in mind.
Mr. Rwani, so I know that, late last year in December, there was the news that Dangote may not optimally distribute his products, because of maintenance and all of it. And we saw a reaction of that at the pump price. Now, with this news, that we have for February and all of that, what reaction can we really expect? What could happen, or what reaction could we expect, both from the players, other players in the industry, especially from them?
Dangote's work program includes maintenance, periodic maintenance. And every time they're going to do that, they already have a stockpile of products and all that. There will be no disruption. Dangote has guaranteed that there will be no disruption at the production level, at the distribution level, and the outlets. So I don't think the panic buying that took place at one point in time, when they said there was a rumor that there was Dangote refinery was going to be closed for maintenance, was just a carryover of the historical prejudice of the past. I don't want to call it prejudice, historical fears of the past, where people are afraid that, because of this announcement, it's not going to come. But in the importation of refined product model, you lock down a price, you order the products, you ship it all the way here, and then from Atlas Group to the various outlets. That was a very long and winding process. But now it's being done locally. The crude comes to Dangote refinery locally. He also imports some. And then he refines. And actually, the refining is a fractional distillation process. They distill. and then you have the products. I can assure you that there will be no shortages and no queues and no disruption to production. And let us be clear in our minds about one thing. The refinery employs a lot of people. The refinery takes crude and processes, but the companies that depend on refined products for logistics, for distribution, right, are the ones that, with the linkage effects on other industries. Those are the ones that benefit more than any other company, than any other sector in the country. And those guys are really having a field day. Things are now more certain, and with certainty comes confidence. With confidence comes more investment. With more investment comes greater output and the quality of life and the standard of living of the people.
All right, Mr. Rani, outside that, I noticed that the gap between the Naira, the value of the Naira, in the parallel and the official market is growing again. As at yesterday, it's about 96 Naira. Should we be worried?
Yes. No, I don't think it will. The point is that the central bank has multiple instruments for managing, one, money supply, two, price expectation, inflation expectations, and also regulating the banking system to say that it's safe and sound. Those are the core. That's the core mandate of the central bank. So when you want to determine whether a currency is a fair value, you have to look at the various ways of computing or addressing an exchange rate. When you look at it, the difference between all of these rates, because there's the official rate, there's the IATA exchange rate for buying tickets, there's the parallel market rate for cash, and then there's parallel market rate for transfers. And then there's the purchasing power parity price or value of the Naira. All of these things are within a band of about not more than 2 or 3%. So 10% of is usually at which point you begin to panic if there's a distortion of 10%. At 1400, 10% is about 140. The difference you see today between the PPP value, the official rate, is much lower than that. If you take the difference between the parallel market on cash in the market and transfers by the central bank, you'll find that it's about 90 Naira. It is still below, it's about 6%. Under normal circumstances, you don't panic if the difference between those two are not in excess, are lower than 10%. So what do we see? We think that the central bank will, over time, they're watching interest rates, they're watching money supply aggregates, they're watching high-powered money and transmission effects. Over time, the central bank we suspect the central bank will begin to bring, will manage those rates and ensure that there's no opportunity for arbitrage. But definitely, we think that the official rate at current levels may need to may need some adjustment. But that the people that work on that in central bank are very clear. They have all the data, and if you want foreign exchange today in the parallel market, you get as much as you want. If you want foreign exchange today in the official market to open an LC, you get as much as you want. And there are no shortages of foreign exchange. We're talking about petrol queues. There are no queues today as far as foreign exchange is concerned. Therefore, the fear that foreign exchange will not be available where you want it, that the exchange rate is going to depreciate sharply like it did 2 years ago, that is far-fetched. Again, and that the currency itself, I want you to bear one thing in mind, that the dollar itself has been falling against other currencies because of the tariff wars and all other things that you're seeing in the global market. We believe that there's a time when you have dollar appreciation or dollar depreciation and Naira appreciation. If it happens at the same time, you'll find that there's no need to panic. But let us look at the Naira versus the pound. The Naira versus the pound went as low. The Naira depreciated to about 2,100 Naira to the pound. It's now at about 1989. Therefore, against other currencies, you'll find that the Naira has been relatively stable. Against the dollar, there's been some volatility because of various things that are happening and the relationship between the price of gold and the value of the dollar. So there's no need to panic. The Naira is not going to fall off the cliff. The Naira has been stable and has been appreciating
All
in the
right,
last
all right, Mr. Irwani,
months.
thank you for that assurance. And we do hope that we don't get back to those days, you know, when the gap
No,
was,
no, no.
was
Those
really,
days,
really
those days are gone and gone
terrible.
forever.
All right. Thank you so much, Chief Executive Officer of Financial Derivatives Company, Mr. Bismarck Irwani.
Thank you for having me.
Let's take a break now. When we come back, we'll be talking about infrastructure funding. Do stay with us. You're welcome back. It's still Business Morning here on Channels Television. With the level of infrastructural gap on the continent, of course, there have been innovative ways to deal with it. One of its major one has been PPP, Public-Private Partnership. And now the Private Infrastructure Development Group, PIDG, through its Project Development Solution, InfraCo, we know InfraCo, they've exited the preference share investments in InfraCredit. Now, InfraCredit, of course, is the Nigerian arm or Nigerian body that's supposed to be a vehicle for local currency financing of infrastructural development in the country. And PIDG is an arm or from the United Kingdom that invested in it. And now they've exited and they made good profits. So let's find out perhaps some of those details that you may want to know when it comes to investing in infrastructural development in Nigeria. Is it a good deal or not? We hear it from someone who has a first-hand experience, and we have the Chief Executive Officer of Private Infrastructure Development Group, Mr. Philip Valau, joins us virtually from Switzerland. Mr. Valau, good morning and welcome to the program.
Thank you, and good morning to you.
Great. So you have had to invest and work with the Nigerian government in the area of infrastructural funding. Could you share with us the experience, the good, the bad, the ugly, so we can learn from it?
Actually, I'll probably just focus on the good because it has been a wonderful experience. Starting in 2017, working with the Nigerian Sovereign Investment Authority to jointly set up InfraCredit Nigeria. And you fast forward today, 8 years ago, there were no pension funds investing in the infrastructure asset class in Nigeria. Mostly they were invested in government securities. And when you fast forward today, you have over 20 pension funds that are invested in that asset class. And working with the regulators back then in Nigeria, they were allowed to invest up to 15% of their capital in the infrastructure asset class. So it's been quite a, I must say, a positive journey, and the ability for InfraCredit to continue to grow and attract capital on its growth journey. So for me, it's very difficult to focus on the bad and the ugly because it's basically been a very good story.
But would you say enough local investors are participating in this space where you have participated and you now have good stories about?
I think we have good stories in InfraCredit. For those who follow it, will be able to look at the various bond issuance that are taken up by pension funds and they're guaranteed by InfraCredit, which have allowed the development of infrastructure assets. And more importantly, perhaps, is the example that Nigeria has set by setting up InfraCredit and the positive results. Other countries and neighboring countries have taken notice. And so it's no surprise today that working with InfraCredit, we're looking at other markets that could be developed in Ghana, in the West African Francophone zone, in Southern Africa. So the model that we set up with NSIA in Nigeria 8-9 years ago, and because of the results that have been achieved, people have taken note on the continent.
So, I mean, the infrastructural gap is not yet closed. Can we expect more from PIDG?
Indeed. If you look at 2025, we had a record year. We deployed over $1 billion through the various instruments, whether it's guarantees, equity, and debt, and we expect to double that. So yes, we expect to continue to play a role given the unmet needs in Nigeria, but elsewhere in sub-Saharan Africa.
What areas can we expect?
Power will continue, electricity will continue to be a critical piece. When we know that over 600 million people do not have access to electricity, that has to be an emphasis for us, but for other players as well. Water is also the digital is increasingly important. So there are various areas and sectors that we will continue to focus on.
So for you and for other potential investors who are watching this program, what advice would you give them if they were interested or they thought, oh, PIDG has made good its participation in infra credit? What can they do? What should they look out for?
I think the biggest message for me is in regards to perceptions of risk. As you will know, whether it's Nigeria or other neighboring countries, the perception of risk continues to be high, despite the fact that data after data shows that the loss rates are low. They're lower than in more advanced economies, and recovery rates are higher. So for me, one of my key day-to-day jobs is bashing that risk perception that continues to persist.
So you think perhaps the government should give more attention to dealing with the perception of risk, because you seem to be saying that the perception of risk is worse than the risk itself in the case of Nigeria.
Nigeria and more broadly. So yes, and the government does obviously play a role there, but institutions like us also have a role to play. And I think companies that have had success, they also have a role and a responsibility to get the word out, because bad stories sell well, but the good stories people take for granted, and we need to get those good stories out.
And what more do you think can be done in the area of innovative financing to accelerate infrastructural development in Nigeria and even Africa, because it's actually an African challenge?
Our key focus for us has been, and when you see in particular the drop in overseas development assistance, you see the drop in some of the players that typically would invest in Africa have retreated or have put investments on hold. For me, it's about localizing solutions. There's plenty that we can do in Nigeria and on the rest of the continent with local solutions and domestic institutions. As we've done in Nigeria with InfraCredit, whether that's a drop in the bucket, there's considerably more that we can do in terms of innovative finance by tapping into local markets and developing those local capital markets.
Would that be the capital market?
Indeed, because when you look at InfraCredit created from scratch 8-9 years ago, allowing over 20 pension funds to get into this asset class, you're effectively developing an ecosystem that wasn't there before, and we need to build on that.
Yeah, what about assets? I had a guest some time ago who said if Nigeria would look inward to generating revenue from its assets. I don't know what you think about that.
In terms of generating more business, or what?
Using some of the assets, the National Theatre, for instance, the National Stadium, using those assets better to generate revenue.
But that perhaps is a sensitive one that I would leave for government to opine on, I think. We've seen it in other countries, and indeed other countries in sub-Saharan Africa are going down that route. That is one to explore, obviously.
So you are partnering AFDB, the African Development Bank Group, to scale up domestic capital mobilization. And we know that the AFDB, they hold a lot of sessions and meetings, with captains of industries on the continent. What can we expect from this partnership between PIDG and AFDB? What can we expect this year, 2026?
I think when you look at the strategy that Dr. Ta, the new president of the African Development Bank, has launched, centered around 4 cardinal points, one of them has to do with the African financial infrastructure. So I would expect, and this is the work that we're doing with the African Development Bank, to put much greater emphasis than has been placed in the past on institutions that work across the financial sector and capital markets in sub-Saharan Africa. These are not just institutions like AFC, AfriExim, TDB that work throughout the continent, but equally domestic institutions that will focus on just one country. And so through a cascading effect, for us, working closely with the African Development Bank, it's about expanding that universe of participants.
All right, thank you so much for your time, and well, congratulations again. A good investment that you did right there. Mr. Philip Palau is the Chief Executive Officer of Private Infrastructure Development Group.
Thank you so much.
Now let's go global with Ladi Williams.
Markets, oil giant Shell stunned investors as its latest quarterly earnings came in below expectation, with profit sliding short of forecasts amid softer energy prices. But in a bold move to reassure shareholders, the company kept its $3.5 billion buyback program intact and lifted dividends, signaling confidence despite the earnings missed. And there you have it, cash flow from operations that came in above expectations, $9.4 billion. Adjusted net profit, $3.3 billion. This was a snag right there. The estimate was about $3.5 billion expected, down from Q4 2024, about 28%. But we see dividend that increased about 4%. Share buyback, that's tagged at $3.5 billion. All right, to other earnings now. Japanese tech giant Sony delivered a standout quarterly performance, reporting an 11% jump in net profit as strong demand for gaming and image sensor products fueled growth. Operating income surged even more sharply. Buoyed by that strength, the company raised its full-year outlook, giving investors fresh confidence in its diversified business model. And there you see the sales there up by 1%, 3.71 trillion yen there. Full-year outlook. Operating profits are up 12%. That's the outlook from the company. Operating income, that rose 22% year-on-year. For the Q3 2025, 515.0 billion. Net income, a big 11% jump there when you compare Q3 2024 and Q3 2025. So it's a good performance there, and they also raised outlook, giving investors more confidence in that company, Sony. All right, turning to the global economy now. Canada's latest services PMI data suggests the downturn in the sector is gathering pace. Heading into this new year, the headline business activity index fell to 45.8 points last month from 46.5 in December. And I'm seeing that trend with most PMIs from different countries right now. Joining me to unpack this, we have Julian Karagesian, is a former special advisor, Ministry of Finance, Canada. Great to have you on the show, sir. Good morning.
Thank you for having me here, Laddie.
So we see Canada's services PMI shows the downturn, accelerating in January. How serious is this slowdown, and what does this signal about overall economic growth in the first quarter?
Well, it's now the third month of contraction for the headline business activity. And what's more concerning is if you look at the gauge for new business, for new service activity, which is in its 14th month of contraction. And you can feel it at an anecdotal level here, and it conflicts a bit with the headline forecast GDP growth of the International Monetary Fund, which is calling for I think a 1.5% expansion of real GDP this year. The services are 70% of the economy. And if they're in their 14th month of contraction and showing no signs of a significant rebound, that definitely conflicts with the latest forecasts that we saw in the fall from the IMF. So it's a tough economy. Unemployment's close to 7%. And of course, we have the major trade policy uncertainty from Washington, as well as the impact of the tariffs themselves.
Yeah, a lot to still think about coming from the U.S. there. But you did mention the services sector makes up, bulk of Canada's economy. Could continued weakness increase, recession risk, or force businesses to maybe cut jobs and spending?
I'm sorry, could you repeat that last part, Lai?
Right, could it, make businesses cut jobs and spending if this, weakness continues?
Absolutely, and unfortunately, in the moment, we're getting like a double hit because the manufacturing sector in Canada is concentrated in the province of Ontario, and the heart of the manufacturing sector is the automotive sector. And that's getting hit by 25% tariffs from the Trump administration. And we've been seeing a lot of plant closures by the big three American companies. So with that kind of situation and dynamic, I do foresee that there could be more labor cutting and less investment. Now, on the positive side, we have these nation-building projects that have been unveiled by the office of the Prime Minister, and now they're in this new office called Major Projects Office, based in Calgary, and there's about a dozen projects, major infrastructure projects and energy, that have been identified and that are going to be eligible for government investment and open to foreign private sector participation. So I do see on the other side the wave of infrastructure spending coming will be a plus for employment, for wage growth, and for GDP, but it's going to take time.
And mostly this has implications for currency. How's the Canadian dollar reacting to this softer data? Is the currency markets now pricing a possible rate cut from the Bank of Canada?
Yeah, it's interesting because you have two major forces that are opposing. As we saw earlier in the weekend, energy prices, oil prices were going up, and that pushed our dollar up because we're a major exporter of oil. 5.5 million barrels a day is produced in Canada, and a lot of that is exported. So an increasing price of oil earlier this week led to a bump up in the Canadian dollar versus the US dollar. But now we're seeing continued service sector softness, and that's starting to hit our dollar. So we have these two forces that are probably going to keep battling for the rest of this year.
Right, and all eyes still on the oil markets. At this point, we did see a pullback earlier today. We'll see if we'll get a rebound at this point. Thank you so much for joining us today. It's great having you as usual. Thank you so much.
Thank you for having me, Laddie. Take care.
All right, we'll see to Kathy Woods now. The ARC ETF published their daily trades. That was yesterday, showcasing significant moments in their investment strategy. The largest transaction of the day was the sale of 258,000 shares of Teradyne Inc. across several ARC ETFs, totaling a substantial $73 million. This sale continues a recent trend as ARC has been offloading Teradyne shares throughout the week. And silver prices tumbled in Asian trade today, leading losses across precious metals as the sector faced a wave of renewed selling that largely wiped out short-lived rebound this week. Spot silver slumped as much as 16.7%. Big swings we're seeing right there in the metals market. I'll give you more updates later on Business Incorporated. That's it on what's playing out in the global economy.
Thank you very much, Laddie, and that's it on Business Morning. Thank you so much for being a part of our program. We'll be back tomorrow with more information for your economy and your bank accounts. That's what we do right here. I'm Minnie John Mekwa. Enjoy the rest of your day.